Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at HIMS and HERS.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, getting right into it, imagine you're building this multi-billion-dollar healthcare empire, right?
Right.
And you're doing it basically by selling $49 copies of, like, the world's most popular weight loss drug.
Yeah, it's a wild premise.
It is. But then imagine waking up and realizing the FDA or some regulatory agency could just, shut your entire operation down with the stroke of a pen.
Just overnight. Yeah.
Exactly. And that's exactly the high wire act we're unpacking today.
Yeah.
Because we are looking at a company that is essentially rewiring how we even think about healthcare access.
They really are, but, they're doing it while trying to navigate this total minefield of pharmaceutical lawsuits and shifting profit margins.
Right. So our goal today is to kind of look under the hood of HIMS and HERS, like get past the daily market noise and figure out how their actual business machine functions.
Yeah, and we need to examine this major pivot they just pulled off, plus decode what institutional investors are doing right now, because it is an incredibly complex case study.
It really is.
You've got a company operating right at this intersection of consumer tech, personalized medicine, and this massive macroeconomic shift in just how people choose to spend their healthcare dollars.
Yeah.
And to really understand where they're going, and I guess why the market is reacting the way it is, we really have to start by looking at the sheer structural momentum they've built over the last few years.
Yeah, let's lay out that foundation first, because the numbers here are just, they're staggering. But I want to make sure we don't just, throw a giant spreadsheet at you listening.
Yeah.
So let's look at their subscriber base first.
Okay, yeah.
They've grown their users by 13% year over year.
Which is huge.
Right. And they are now sitting at 2.5 million subscribers. That is 2.5 million people paying them every single month. So when you have that kind of user base, what does that actually translate to in terms of top-line revenue?
It basically translates to a massive upward trajectory. So for the full year of 2025, their revenue came in between $1.85 billion and $2.35 billion.
Wow.
Yeah, and that depends on, which segment outperformance estimates you're looking at. But just to give you some context on that growth, they were at $1.48 billion in 2024.
So that's roughly a 59% year-over-year jump?
Exactly, a 59% jump. But, revenue is really only half the story in the tech and telehealth space.
Oh, for sure.
Because historically, companies in this sector just burn through mountains of cash trying to acquire those users. They show huge revenue, but, massive losses.
Right. That's the classic Silicon Valley playbook. Lose money on every transaction, but make it up in volume, right?
Exactly, but HIMS and HERS has kind of broken out of that phase entirely. They are actually profitable, and I don't just mean through, clever accounting tricks either.
Really? Actual profitability?
Yes, real profitability. We are looking at GAAP net income, which, is the strictest, most universally accepted accounting standard out there for profitability. And that hit somewhere between $128 million and $145 million for 2025.
That's incredible.
Yeah, and in the fourth quarter of 2025 alone, they brought in $617.8 million in revenue. That practically nailed the consensus estimates from Wall Street.
Wow. And looking forward, their adjusted EBIT guidance for 2026 is sitting somewhere between $300 million and $375 million.
Which is huge.
It is. And for anyone listening who, glazes over at financial acronyms, EBITDA is basically just a way to measure a company's raw operating profit before things like taxes and depreciation muddy the waters. So they are generating real cash.
Real cash.
And they're doing this with a pristine balance sheet. They have zero debt and over $300 million in cash just sitting in the bank.
Which is such a tremendous advantage in our current environment. Zero debt means that while their competitors are spending a significant chunk of their revenue just, servicing loans and paying interest to banks, HIMS and HERS is taking that exact same cash and plowing it directly back into user acquisition and platform improvements.
Okay, let's unpack this, because this is the mechanism that really fascinates me. 90% recurring revenue. That's the holy grail.
It really is.
It's essentially a streaming subscription service, but instead of movies, it's personalized medicine for chronic conditions.
Right.
They are locking in users month after month for customized hair loss treatments, heart health management, and of course, weight loss.
Right.
But how do they keep people from just taking their prescription and going down to the local pharmacy? What's stopping them?
Well, that comes down to their structural moat. And that's built on pure vertical integration. So in a traditional healthcare model, the system is totally fragmented.
Oh, it's a mess.
Yeah, you use one system to find a doctor, then you go somewhere else for the consultation, your prescription gets sent to a third-party pharmacy, and maybe your insurance is like a fourth party trying to negotiate the price.
Such a nightmare.
Exactly. But Hims and Hers doesn't just run the app where you talk to a doctor. They actually own the telehealth platform, and they own the pharmacy fulfillment centers.
So they've just removed all the friction and the middlemen from the entire process.
Yep.
They control the whole customer experience from the moment you log on with a concern to the moment that discrete package arrives at your front door.
And that vertical integration is everything because it creates incredibly high switching costs. I mean, think about the user psychology here. Once a consumer has their customized medical routine dialed in through this, seamless digital platform, the friction to leave is huge.
Oh, I'm sure.
If you cancel your subscription, you have to go back to the traditional brick-and-mortar legacy healthcare system.
I have to wait in line.
Exactly. Wait in line, deal with paper prescriptions, and potentially face shortages at your local pharmacy. This vertical moat completely insulates Hims and Hers from those traditional competitors.
It is a beautiful machine when you lay it out like that. I mean, a completely self-contained ecosystem generating massive free cash flow.
Oh, yeah.
But if we stop the analysis right here, we definitely aren't telling the whole story.
Definitely not.
Because if the fundamentals are so incredibly strong, we have to ask a very uncomfortable question.
Right.
Why did we see this stock completely fall off a cliff recently? I mean, we were talking about a brutal 55.2% drop from their highs in September of 2025. You do not see half of a company's market cap just evaporate unless Wall Street is genuinely terrified of something fundamental breaking.
And that is the pivotal piece of this whole story. What terrified the market was the regulatory landscape, specifically around their weight loss segment. Because a massive driver of that $2.35 billion in revenue and those incredibly high profit margins they were enjoying was their compounded GLP-1 weight loss drugs.
Okay, let me stop you right there because compounded GLP-1 is a term that gets thrown around a lot in financial media, but it rarely actually gets explained.
Fair point.
We know GLP-1s are the incredibly popular weight loss injections that everyone is talking about. But what does compounding actually mean from a legal and operational standpoint? Like, are they just mixing up bathtub copies of patented drugs?
Well, it is not quite a bathtub operation, but it is this legally gray area that exists because of supply chain failures. So when there are massive national shortages of a vital FDA-approved drug, like we've seen with the major brand name weight loss injections.
Right, the shortages have been crazy.
Yeah. So when that happens, the FDA allows specialized compounding pharmacies to create customized generic versions of those drugs just to meet patient demand. It is an emergency stopgap measure.
I see.
And Hims and Hers capitalized on this FDA shortage list brilliantly. They started offering their own affordable, accessible, compounded GLP-1s for around $49 a month.
Which is wildly cheaper than the $1,000 a month price tag on the branded versions.
Yeah.
I mean, it became a cash cow.
Oh, a massive cash cow. But the risk associated with that revenue stream is astronomical. You are dealing with intense regulatory scrutiny. I mean, the FDA is constantly issuing warnings about the safety and consistency of compounded drugs.
Right.
And on top of that, you have aggressive existential lawsuits from the massive pharmaceutical companies that own the original patents. Companies like Novo Nordisk, who make the branded drugs, they are fiercely protective of their intellectual property.
So Wall Street looked at this massive $49 a month subscription revenue stream and realized it was basically built on regulatory quicksand.
Exactly.
If the supply chain catches up and the FDA declares the shortage is over, the legal loophole just closes.
Yep.
One stroke of a pen, and Hims and Hers has to stop selling their most profitable product overnight. And that is why the stock dropped 55%. Investors were pricing in the sudden death of the weight loss segment.
They were. The legal overhang was completely suffocating the stock's valuation, but then the company executed a massive strategic pivot. They didn't just wait around to get shut down by the FDA or sued into oblivion.
They took action?
They did. They partnered directly with Novo Nordisk to offer the actual branded versions of those weight loss drugs. They transitioned from selling the controversial compounded copies to selling the official, fully backed branded medications.
Okay, here's where it gets really interesting. And I have to push back a little because they basically bought peace of mind by partnering with Novo, but it cost them 6% in margins.
Right, it did.
We saw their gross margins, which historically sat at a beautiful 80% or higher, drop down to 74%. Because obviously branding partnerships just aren't as profitable as compounding the chemicals yourself. You have to pay the toll to Novo Nordisk.
You do.
Now, the stock currently trades at a forward PE ratio of 32x. That means investors are willing to pay $32 today for every $1 of future earnings. That is a very premium valuation. At a 32x forward PE, is Wall Street really okay with them sacrificing profitability just to dodge FDA scrutiny?
What's fascinating here is how counterintuitive it seems, right? You would think a drop from an 80% margin to a 74% margin would cause an absolute sell-off.
Yeah, usually it does.
But Wall Street isn't just okay with it, they are actively rewarding it. Here's the mechanism you have to understand. 74% gross margin is still exceptionally high for any business.
That's true.
But more importantly, resolving this legal overhang was crucial for the company's actual survival. You just cannot safely scale a business to 2.5 million subscribers with regulatory doom constantly hanging over your head.
Right, it's just not sustainable.
No. The Novo partnership completely legitimized their entire weight loss segment. They traded a few points of margin for permanence.
I see. It is essentially like buying an expensive insurance policy on your own business model. You pay the premium to the pharmaceutical giant, your profit margins take a slight hit every quarter, but you can finally sleep at night knowing your house isn't going to burn down tomorrow.
That is the perfect analogy, and the market's verdict on this pivot has been incredibly clear over the last few weeks. If we look at the recent price action, the technical breakout is just impossible to ignore. On March 12, 2026, the stock soared 10.3% in a single trading session.
Which is a massive move.
Massive. It closed at $25.88. That move extended a 3-day winning streak, and, crucially, it cleared major psychological resistance levels that had been trapping the stock since that huge 55% drop back in September.
So it represents a complete psychological shift in momentum. And it's not just like retail day traders chasing a shiny headline, right? The professional analyst actions are backing this up. Barclays just came out and raised their price target on the stock from $25 to $29, and they hit it with an overweight rating.
Let's quickly clarify what an overweight rating means in this context, because it's important. It means Barclays is telling their institutional clients that this stock is expected to outperform the broader market or its specific sector.
Oh, yeah.
It is a massive signal that institutional money sees the Novo deal as a green light.
Right.
Furthermore, if you look at the quantitative sentiment scoring, which is where algorithms scrape all the top financial news feeds and analyze the overall mood and phrasing, the data is overwhelmingly bullish right now.
That makes sense.
The legal disputes are resolving, the branded GLP-1 access is totally secured, and the narrative has shifted from risk to execution.
And, there is another signal buried in the news that I think is incredibly important, maybe even more important than an analyst upgrade.
Oh, yeah.
Yeah. They just brought on a woman named Catherine Beiser to lead their communications strategy, and she will be reporting directly to the CEO. Now, why does a communications hire matter to investors? Because she is a former executive at Eli Lilly. They didn't just secure a pipeline of branded drugs, they poached a communications exec right out of Eli Lilly. That's a serious flex that signals internal confidence to the market. You don't leave a legacy giant like Eli Lilly for a company that is about to be shut down by the FDA.
That is a phenomenal point. When you are pivoting from a gray market compounding operation to an official branded partnership, your messaging to regulatory agencies, to your partners, and to Wall Street is literally everything. Bringing in an insider from Eli Lilly totally validates their intent to play in the big leagues.
Absolutely.
And this ties directly back into who is actually buying the stock right now. The stock has seen an 85% recovery over the past year. When you combine that kind of sustained upward trajectory with the exceptionally high daily trading volume we've been seeing, it strongly signifies massive institutional accumulation.
Meaning the smart money, the mutual funds, the pension funds, the big institutions, they are loading up on shares. They aren't just trading the news cycle. They believe this pivot is a permanent structural upgrade.
Exactly. They are buying in for the long haul.
So the foundation is solid, the legal risks are mitigated, and the big money's piling in. But as investors, or even just observers trying to understand this business, we always have to look forward. So what is the catalyst calendar telling us? What specific events should we be watching over the next 3 to 6 months to validate this thesis?
Well, the biggest immediate milestone is their Q1 2026 earnings report, which is likely coming up in May. And there is a very specific nuance in their forward guidance that everyone needs to understand because it could easily be misinterpreted.
Okay.
The company's own Q1 revenue guidance came in at $600 million to $625 million. However, the broader market consensus, what Wall Street analysts were hoping for, was $653.9 million.
So what does this all mean for the next 2 months? If I'm looking at Q1 guidance, it technically missed consensus. Should investors be spooked by that shipping headwind? I mean, a miss is a miss, especially when the stock is trading at a premium valuation.
Right. It looks bad on paper, but it really comes down to the underlying mechanism of why they missed. The company has explicitly stated that this slight revenue miss is entirely due to a $65 million shipping headwind.
Oh, interesting.
Yeah, it is a logistical bottleneck. It's a supply chain timing issue regarding fulfillment. It is absolutely not a demand issue.
So it's not that people stopped subscribing or stopped wanting the medication.
Right, exactly. People are still logging on, they're consulting with doctors and ordering the treatments. The revenue is simply being deferred into the next quarter because the physical packages are facing shipping delays.
Got it.
And we know the consumer demand is completely intact because the company simultaneously reaffirmed their full-year guidance of $2.7 billion to $2.9 billion. If demand was truly falling off, they would have been forced to slash their full-year projections.
That distinction is critical. I mean, a shipping delay just pushes the money into the next quarter.
Yeah.
It's on the balance sheet as deferred revenue. But a demand issue means the customer walked away and the money is gone forever.
Precisely. And if we connect this to the bigger picture, the macroeconomic tailwinds pushing this platform forward are just staggering right now.
Yeah, let's talk about those.
First, we are in the middle of a GLP-1 supercycle. The global demand for these weight loss treatments is unprecedented, and supply is still struggling to keep up. Second, we have potential interest rate cuts on the horizon.
Right.
And historically, when interest rates drop, we see a massive sector rotation where institutional capital flows back into high-growth, tech-forward companies, which obviously perfectly describes telehealth platforms.
And we can't ignore the rumblings about international expansion either. There are speculative rumors flying around right now about HIMS and HERS pushing into Europe for their core weight loss and hair loss segments.
Yes.
And given that they have over $300 million in cash and zero debt, they are perfectly positioned to fund an aggressive international rollout without having to, dilute shareholders by issuing new stock.
That cash pile is an absolute weapon they can use for global expansion. But, the most powerful macro factor of all, in my opinion, isn't about interest rates or European markets.
What is it?
It is a behavioral shift that we are calling insurance fatigue. Just think about the actual visceral experience of dealing with traditional health insurance right now.
Oh, man, it is a totally broken user experience. You wait weeks for an appointment, then the doctor writes a prescription, you drive to the pharmacy, wait in line, and then the pharmacist tells you that your insurance requires a prior authorization.
Yep, the dreaded prior authorization.
So you spend hours on hold dealing with denial letters, trying to figure out if a simple standard of care medication is actually covered by the premiums you already pay. It just strips the dignity out of healthcare.
It really does. It is exhausting, and consumers are finally reaching a breaking point. What we are seeing in the data is that people are actively choosing to bypass their own health insurance entirely. Yeah, they would rather log on to a digital-first platform like HIMS and HERS, pay $40, $50, or even $100 out of their own pocket in cash, and have the medication show up at their door 2 days later. They're paying a premium for speed, for privacy, and for sheer convenience.
Which completely flips the script on how the healthcare economy is supposed to work.
Yeah.
You have people who theoretically have full medical coverage, but they refuse to use it because the bureaucratic friction is just way too high.
Exactly. The macro tailwind of insurance fatigue is so strong that cash pay platforms are capturing a massive demographic of middle-class and upper-middle-class consumers. They are building this parallel healthcare system that runs purely on convenience and transparency.
Okay, we have covered a massive amount of ground here. We've dissected the subscriber growth, the regulatory drama, the margins, the consumer psychology. Let's synthesize all of this. When you look at the fundamental strength, the pivot away from regulatory risk with Novo Nordisk and these massive macro tailwinds, where does this leave us on the final investment thesis?
Well, based on all the fundamental data, the quantitative sentiment scoring, and the incredibly sticky structural moat they've built, this sits at a very strong 8 out of 10 bullish score.
An 8 out of 10.
Yeah. The elevator pitch for the company is incredibly clean right now. You are looking at a zero-debt cash machine that has successfully pivoted away from the high-wire act of compounded GLP-1 risks. They have secured their future through a branded Novo Nordisk partnership, and they are leveraging 2.5 million subscribers to fuel up to $2.35 billion in 2025 revenue.
And based on the institutional buying patterns, the target horizon here isn't like a quick day trade to catch a headline.
No, not at all. This is structured as a multi-year hold into the 2026 earnings ramp. The vertical moat they've created by owning both the telehealth platform and the pharmacy fulfillment, combined with over 90% recurring revenue, makes this a tremendously resilient long-term play. If they execute on the international expansion rumors, that is just additional upside that isn't even fully priced into the current 32x forward multiple.
It really is a masterclass in adapting to survive a regulatory threat and then using that newly secured foundation to scale and dominate the space. But, there is one final piece to this puzzle that points to where the entire industry might be heading. We've talked about how insurance fatigue is driving people to pay cash for these services. But with HIMS and HERS generating massive free cash flow, they are looking at hybrid insurance models next. They want to integrate the speed of cash pay with the financial coverage of traditional plans. Here is something to think about. If a digital-first platform can seamlessly bridge cash pay speed with traditional insurance coverage, are we watching the slow, inevitable death of the neighborhood pharmacy?